This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to the homepage, macrovoices.com, click the red button above Ola's picture that says Looking for the Downloads. Patrick, the deck is titled Technical Crossroads, and sure enough, on page 2, we've got S&P 500 futures. What's going on here?
Well, I wanted to zoom out to a weekly chart and really kind of put in context the comments you made at the market wrap at the beginning. Like when you really reflect on how the price of equities have performed over the last 2 years since the COVID lows, this market correction that we are in has been relatively tame and contained. Just to put it into context, in order to just retrace 50% of the prior rise, it would involve a 25+% market correction down to 3,500, where I know there's a number of prominent macro strategists that have talked about that number even a year ago. And the point here is that we now have traded right down to that March low from just a couple months ago. And what we find ourselves in a situation where the big question is, will we see that S&P break to a fresh low? And does that create a short-term liquidity event where the selling feeds on itself in a kind of a negative gamma way that basically creates like an air pocket drop that the market is so typical of doing when things get out of hand? We'll be watching very closely this previous low and what it does there. Now, to put that into context, on page 3, I wanted to just highlight that percentage of stocks above their 50-day moving average breadth indicator. And what I wanted to simply highlight was the fact that we have now reached the oversold state that prior market corrections have ended in. Now, it's not necessarily a forecast that means this one will turn, but we have now seen oversold conditions enough that if it was just a market correction, then this would be typically where, at least it has in the past over the last year or two, marked a short-term tradable low on the market. And the interesting part, and this is what I mean by crossroad, is that if we see that March low given out on the stock market, then we're talking about a breadth indicator that could be heading down towards those COVID March lows, and where we get some very extreme oversold conditions. And certainly it would no longer fit the criteria of a correction, but rather it could even start getting into bear market territory if we saw that. And the other thing to kind of collaborate that is looking at the Volatility Index, or the VIX, on page 4. And most market corrections tend to contain themselves to just these quick little spikes up to 30. And then we see a reversal of the trend as dealer buying forces a slingshot rally the other way. And so we have now reached that stage on the Volatility Index where we have typically seen short-term lows on the stocks emerge. And so this is what I mean by the technical crossroad, is that it's an important moment where we're going to find out, does the stock market behave the way it's been behaving in the last year, which is put in a short-term low, or are we about to see the floodgate open and something more ominous is about to occur?
Patrick, I think that's a brilliant insight, but I want to take it a little bit further and just come to some conclusions. You're saying this is the crossroads. So if I look back to page 2, would I be correct to interpret your whole prognostication here to be that if we break decisively below that top red line, which looks like it's at about 4,200 or so, if we break below that line and it's a sustained move, then you think 50% retracement down at 35 something is the next logical target?
Certainly, a 50% retracement of the prior rise is a very typical target. I mean, obviously, that's not necessarily a forecast as much as a reasonable target zone to anticipate. And I know we've heard a number of macro strategists even calling for 3,000 or lower. But I think a starting point for a deeper market correction that would leave the market in that kind of 20 to 30% market correction territory if we saw that kind of a downdraft. I'm not so sure that the market will make the break, but if it does, it should happen relatively quickly. And in the 3,500, I think, is a very reasonable target for a downdraft to go.
Patrick, let's move on to page 5. I'm going to make the statement that this crossroads is absolutely as important as the equity crossroad that you talked about, because the high that we had back in 2016, I think it was 104 spot something, looks like we're just coming up on that again. Seems to me if we break above this line, that was the prior high of 104 spot something from 2016, really, the sky's the limit. We're looking at probably back up to 120 or so, which was the high from the early 2000s. We got to higher numbers way back in the early 80s, but barring that, it's almost all-time high kind of targeting that I'm looking at. And I think we probably could get to an all-time high in the U.S. dollar before eventually 10 years from now, we get to a replacement for the dollar, in which case the dollar is going to go the way of the pound sterling, and it won't be pretty. But that's not happening yet.
Right. Well, I wanted to just zoom out on the monthly chart just to put this into context, because when we look at it on the daily chart, obviously it's been a little bit of a parabolic rise. But it's not only that we've approached that 2016-17 kind of high, but the last time the dollar traded above that level was going back to 2002, 2001 period. And so if the dollar was to break out above these levels, it takes us into a territory of not uncharted waters, but certainly one that really asks the question as to whether a dollar bull market has been set in motion that could stay in trend for years. The key here, obviously, we're quite overbought, and usually, and it's a typical response, is for the prices as they approach these kind of key overhead resistance levels to bump their head and stall out a little bit along there. And so I'm not necessarily implying that we are going to get this monstrous breakout this week. And more importantly, when looking at monthly charts, one has to look at this as multi-year trends and not necessarily, what's going to happen next week. But we are at a very important moment. This chart, I would argue, is way more important than the equity chart because the implications of a brand new U.S. dollar bull market resuming with a push back to like 2000 to 2001 highs would have profound impacts on the macro space, and this is the thing that we should be continuously talking about throughout the year for sure.
Patrick, I want to add one more comment because as investors, our job is to always question how could we be getting it wrong. The reason I think we're going much higher is because I'm convinced that Russia-Ukraine is not a conflict unto itself, but rather just a battle in the context of a much larger war that's going to go on for many years to come. If I've got that all wrong and the whole Russia-Ukraine thing is about to de-escalate, get resolved, everybody's going to kiss and make up, Vladimir Putin is no longer considered a bad guy, and everybody's happy, then the dollar's done here and it's going to go straight back down. I don't think that's going to happen, unfortunately, but that would be the case is if I've got the war picture wrong and it really is Russia-Ukraine is an isolated thing, then once that's over, it's over. That would be the case where I think the dollar is, if anything, very much overbought and due for a big correction. I don't think it's going to go that way, though. Let's move on to crude oil on page 6. We've got a triangle pattern here. What I've been waiting for is the break above that upper trend line on the triangle. I think it's coming, not sure when. I'm almost certain that it will be news-driven, and I think that it will also cause technical traders to really start to jump on, and we'll see a new rally up to whatever the next level is.
Yeah, no, the typical nature of markets from a technical perspective is that they have strong trending impulse moves in the primary trend, and then they backfill and correct the trend, consolidate, get unwindled or overbought state, and then prepare for a resumption in the primary trend. The question that and the puzzle to solve here is that how long and how deep does this correction go before that next bull trend resumes? Clearly, each time crude oil has sold off through April, it's made higher lows, which basically means that almost all dips are being bought quite quickly, and the price is holding up very well, especially in a market where the dollar is ripping and most risk assets are being heavily sold. Oil is being well defended and accumulated. You're absolutely right that we can talk about that trend line, but I think just clearing those April highs will be really just an advertisement that the next leg has begun, and that could certainly take oil to a fresh new high for the year, and it'll certainly be interesting to see whether we get those breaks in the coming week.
Let's take a look at natural gas futures on page 7. What's going on there? It's interesting that the shape of the chart is so much different from crude oil, considering they're both energy resources.
Well, exactly. What's interesting is that natural gas just didn't participate at all in the start of the year, at least the North American contract didn't. And then really through March into the first part of April, we saw a doubling in the natural gas prices as we went from $4 to $8. We just had a quick little pullback that saw a quick 5-day market correction occur. And this is at a really important level in my mind, around the $7.50 level, where we're currently seeing the highs from yesterday. I think that if nat gas can break these levels on the upside, then we could still see another full leg higher. This has been a really strong trend, and it doesn't seem to be quitting. And so while, again, we see a lot of risk assets selling, these energy markets continue to actually take a lot of flow.
Let's take a look at copper futures on page 8. Wow, we really have a pretty significant consolidation that's been lasting almost back for a year now.
Well, I wanted to, because we typically look at the daily charts on copper, and I really wanted to step back and kind of reflect on what happened, because Ole talked about this and his bullishness on the sector and the commodity. And what I was just looking at, well, obviously we had an incredibly bullish run through 2020 and 21 on the upside, and really we've now spent a year in a sideways consolidation, and maybe it's the fact with a gross slowdown and what's happening in China. Copper right now is clearly stuck in the mud. It failed to hold a 52-week high breakout just a couple of weeks ago, and now we're in a situation where this is going to stay stuck in this range. But the bigger question here is when does this start to exhibit characteristics of bullishness that is resuming its bull trend? And right now, while we certainly can take a lot of bullish stances on a potential breakout in oil and potentially a continuation in nat gas, it really does look on the short term that copper is stuck in the mud here, and it may take the other side of a global slowdown for the next major bull run in copper to really get some traction.
Let's move on to uranium on page 9.
So uranium had a really good bull run through March and April. We saw this is obviously using that Sprott physical uranium trust unit, and we really got caught in the risk-off cycle here in the last couple of weeks. But what will be really interesting to see is if the characteristic of dips being bought emerges here. And so as this pullback occurs, we've seen in the past that these types of dips would quickly get bought, and we'll want to see whether or not this unit can actually work its way back to like $18, $19 on the upside, and whether uranium can really get some more traction. So we're going to be watching to see whether this gets bought on dip. So what I wanted to wrap things up with here, Eric, was just looking at corn. And obviously, we could also have put up wheat and soybean. But what is interesting is when you take a look at the food commodities, they really have not consolidate downwards the way a lot of the industrial metals and other things have been recently hurt. Here we have corn pretty much trading at its 52-week highs and continuing to plug along, and the other grains continue to do well. And we continue to see the inflation pressures on food continue, and certainly this is one of those commodity trends that just remains in play.
Patrick, I think that food is going to be a really big deal in coming years. Unfortunately, I think that we're headed towards global food crises. And the reasons that I predict that are that we've really been in a very, very delicately balanced agricultural economy. We have a huge, huge population explosion problem. Elon Musk telling the world that we need to increase birth rates is about the stupidest thing even Elon has ever said. We have a problem with too many people on the planet and not enough space for everyone, enough ability to make enough food for everyone without the use of modern fertilizers, modern farming equipment, and so forth. As you get into this war situation where a lot of food is produced in Russia and Ukraine, but particularly a lot of potash that's used to make fertilizer is produced there. When you don't have the ability to fertilize crops as readily as we're used to, it means you can't make enough food to feed everybody, and you get to shortages. As I said to Ola Hansen in this week's interview, I'm not talking about the cost of coffee at Starbucks going up. I'm talking about entire small nations being in poverty and famine conditions because of what I think could be coming in the next several years. And we've really got to think carefully about this. And whatever you do, don't listen to Elon Musk. On the other hand, if you'd like someone intelligent to listen to, you can get Patrick's chart decks, not just once a week here on MacroVoices, but every single day with a free trial of Big Picture Trading, Patrick's service, which you can find out more about on page 11 and 12, or you can just go to bigpicturetrading.com and click on the button to sign up for your free trial.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.